Hey, Jason here. Today's video, I'm going to answer the question, should you buy Alibaba, stock ticker BABA, stock after the tech crackdown in China? This is stock analysis for Micky, who requested this on YouTube.
Before we get to that, though, I need to let you know you can get this series as a podcast anywhere in the world for free on all major podcasting platforms: Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this part of the I Love Value Investing podcast anywhere in the world for free. And if you like this video here on YouTube and our other videos, make sure to subscribe, hit the notification bell so you're notified every time we release a new video, and release new videos all the time.
Okay. I apologize for this. I don't want to do this. I have to do this because every time I don't, I get nasty comments. I do not short sell ever, so I don't benefit from any stock I talk negatively about. I also don't own any stock in a long position about any stock I talk positively about. These videos are done at the request of viewers who want me to analyze stocks for them. Why? To learn how to evaluate stocks better and faster. Because these are viewer requested, I often don't know what the company does. When that is the case, I purposely keep it that way. Why? So I'm not biased either negatively or positively about what the company does. This also means I don't care about what the company says they're going to do in the future. I don't care about how the CEO says they're going to take over the world. I don't care about any of that until far later in the analysis. This is done for your informational purposes only, to help you learn how to value and evaluate stocks better and faster and more efficiently. So you can spend more time evaluating great potential stocks, less time evaluating crap stocks. Why should you listen to anything I have to say? In the first 9 years of my career, I produced average annual investment returns of 23.5% per year on average. This puts me just behind the great Warren Buffett when compared to the first 9 years of his career when he was at the Buffett Limited Partnership and he produced 24.2% average annual investment returns. I'm not saying that to brag. I'm not saying that to even compare myself to Buffett. The only reason I'm saying this is to prove to you that I actually know what I'm talking about a little bit. Okay, again, apologize for that. Don't want to do that. Fortunately, have to do that. Okay, let's get out of here. Again, so this is Alibaba stock analysis, and we're looking at it after the tech crackdown in China. This is a stock analysis for Micky, who requested this. Unlike most companies we do here, I do know what Alibaba does, but for those of you who don't, we'll get to that in a second. Okay, so near their 52-week stock price range. That's interesting to me because that may mean that they are undervalued potentially. Consensus forward PE, I don't care much for forward PE, or really at all, but when I do, I want to see this under 20, so this is one sign the company might be undervalued. Okay, for those of you who do not know what they do, I'm not going to read this whole thing, that's a lot. Let's go here. Alibaba is the world's largest online and mobile commerce company, measured by gross market value, I'm assuming what that means, GMV, Chinese yuan of 6.6 trillion, US dollar 1 trillion for the fiscal year ended March 2020. It's a confusing sentence. It operates China's most visited online marketplaces, including Taobao, which sells consumer to consumer, and Tmall, which sells business to consumer. Alibaba's China Commerce Retail Division accounted for 69% of revenue in the December 2020 quarter, with Taobao generating revenue through advertising and other merchant data services, and Tmall deriving revenue from commission fees. That's a very confusing paragraph. Alibaba, what they do. Here, I will show you, because that was incredibly confusing. So, this is Alibaba. If you've never been to the site, you can buy stuff in bulk, products, gifts, accessories, and you can either sell them, resell them at a higher price. For example, flashlights over here, or you can keep them, or you can do whatever with them. They are a bulk product selling company. Is probably the best way to put it. Okay. Okay, the revenue has skyrocketed, which frankly is not surprising with me. Again, I've known of Alibaba for a long time, a lot longer than most people, because I used to sell stuff on eBay and Amazon. So I've known about them for a lot longer than frankly, a lot of Americans have. And I'm not surprised that their revenues have skyrocketed, because that kind of stuff that you can buy off of Alibaba and get shipped at relatively cheap prices helps a lot of different companies, helps a lot of different businesses. You can do outreach, you can do gifts, you can sell stuff on Amazon and eBay, you can do all sorts of stuff with these products. Their revenue has skyrocketed from 2012, 20 billion Chinese yuan to 769 billion Chinese yuan in the trailing 12-month period. That is, frankly, an amazing growth rate. With that, their operating income has increased drastically, but their operating margin has fallen drastically. I'll get to what that means in a second. That in 2012, their operating margin was 26.7%, rose up to a high of 48% in 2014, which is frankly absurdly good. And then it's fallen to 11.2% in the trailing 12-month period. What does that mean? Frankly, this is not surprising to me, mainly because companies that grow rapidly, which they have grown rapidly, their operating profits typically fall because they can't keep costs under control as well as they did when they were smaller. Now, is that necessarily a good thing? Their margins have fallen as their sales and their operating income has gone up significantly. It's not a great thing, frankly, that their margins have fallen from 48% from 2014 to 11.2% in the trailing 12-month period. But I look for anything above 10% on a consistent basis here. They surpass that every year. And frankly, again, company was never going to sustain operating profit margins of 48%. Pretty much no companies on earth do that, especially hard asset companies like this one. And again, they are not a hard asset company in a normal sense, like a manufacturer or a retailer. They own they're like more of a platform company. They're similar to eBay or Amazon. When you think of that, they are a marketplace, a platform, whatever you want to call it. Over time, their shares have increased from 2.3 billion in 2012 to 2.8 billion rounded up in the trailing 12-month period. Again, that's not necessarily a great thing, but it's not unsurprising because they need cash to fund their rapid growth, even though they're making a ton of cash. If they're making a ton of cash, and they are, they can further accelerate that growth by issuing shares to raise even more cash to further accelerate that growth. So that's not a huge deal here. It's not great, but it's not a huge deal either way. Book value per share has skyrocketed again, like pretty much everything else here in the from 2015 at $8, and that's in US dollars, $8.85 per share to $56.16 per share in the trailing 12-month period. That is a sign that the underlying intrinsic value of the company is going up at a pretty rapid pace in the last 6 years or so, 6-7 years, and that is a good thing. Again, we'll see if that's due to acquisitions, goodwill, all that stuff in a second. Free cash flow is just skyrocketed. We'll talk about that in a second. ROICs are fantastic. Again, huge bump up until 2014 and then falling. But I look for anything above 10% here, and they are just below that threshold in the last decade, or in the last 5-6 years. So they are right at that threshold, and that is a good thing. Free cash flow to sales has free cash flow has skyrocketed. Free cash flow to sales has actually gone down a little bit, again, as the other margins have as well. But I look for anything above 5% on a consistent basis here. This is at 22.4% in the trailing 12-month period, and it's been every year above 22. Actually, that's the lowest of the entire decade. So that is, frankly, really good. They have a decent amount of cash on their balance sheet. Cash makes up 28% of their balance sheet. Intangibles as a percentage of the balance sheet has gone down, which is a bit surprising. They have a minimal amount of short-term debt, minimal amount of long-term debt. All of these are very good. That means the That leads to generally more margin of safety. We'll see what the actual numbers are here in a second. They do have a cash converter cycle, which is a little bit surprising because they're a platform. They are a marketplace. They don't own, as far as I know, any of the hard assets they are selling. So I don't know why they have a cash converter cycle here, frankly, unless they've gotten more into hard assets in recent years, which could be an explainer, because that only is 2018 through 2021. They have that cash converter cycle, the actual full cash converter cycle number here. Okay. Oops. Let's go to the quarterly. Okay, so they have a lot of cash, 483 billion Chinese yuan in cash. That is, what is that? What was it, 483 billion? That's 76 billion in cash equivalents to short-term investments, and they are what is the market cap? Is this in US dollars? It is. So that's a good chunk of their market cap made up in cash equivalents and short-term investments. That's, again, more margin of safety. They have a ton of prepayments and deposits as well, which adds even more to the margin of safety, because that is stuff people are going to pay at some point. And we haven't talked about this number, and that number has skyrocketed since quarter 2 2021. That was 18 billion Chinese yuan. Now it's 127 billion. So I want to know what that is specifically by going into the financial reports or to the 10K. Decent amount of property, plant, and equipment. Not surprising. Again, they have to have a lot of space for all the servers, to run this platform and stuff. Do have a lot of goodwill. Let's go to the annual to see how much that's gone up. Oops. Goodwill. It's gone up pretty significantly. So it looks like there's been some acquisitions, which again is not surprising. Not necessarily a good thing or bad thing in this case, because they're so large. Usually when we talk about goodwill, it doesn't add a ton of, or it doesn't add really any value. In this case, maybe it does, because they're so large. But that's to talk about later. They have a ton of long-term equity investments. I want to know what this is specifically. 454 billion Chinese yuan. I'm assuming, again, that's owning the subsidiary companies, stuff like that, Taobao, the other stuff we talked about briefly. Again, I would want to know what that is later. Minimal short-term debt and capital lease obligations. Minimal long-term debt and capital lease obligations compared to their cash. Again, that adds more margin of safety. They have a ton more cash than they do have debt. That adds more margin of safety to the company. Other than that, they have a very clean balance sheet. Very, very, very clean balance sheet. Let's go to the cash flow statement. Their cash flow statement is not complete. Not sure what's going on there. Not sure if this is a Morningstar data issue, not pulling in the data properly. Let's try reloading that. Or this is something else, but their cash flow statement is not complete. So I cannot give an analysis on the cash flow statement. Let's try the annual. Oh, there we go. So something was wrong with the quarterly, it looks like, on Morningstar. So we have to look at the annual, which at this point is frankly almost a year behind. So it's not going to have much bearing, but we can still tell or look at what they're doing kind of over time. Some minor impairments and write-downs, not a huge deal compared to their size. Other than that, their cash flow statement is very clean as well. Some small acquisitions. well, small compared to their size. Purchased a bunch of investments here in 2021. I would want to know what those are. But overall, issuing stock, they issued a bunch of stock in, was that 2020? To raise cash, not surprising. Proceeds from long-term debt. Again, they issued cash or shares and debt in 2020, 2021 because of all the COVID stuff, and a lot of companies did that worldwide to raise as much cash as possible. Not surprising. And yeah, very clean balance sheet, very clean cash flow statement. That adds a ton of margin of safety to the company. At this point, Alibaba looks like a great potential investment to further research. We will see what the valuation shows, though. And okay, I'll get to the valuation in a second, or the full valuation in a second. Up top, though, I don't care much for PE, price to cash flow forward PE. When I do, I want them to be under 20 to show the company is undervalued. PE is at 19, price to cash flow is at 13.3, forward PE is 18.3. These are all below the 20 threshold. The most important number on here, though, is this, enterprise value to EBIT. This is at 15.6 rounded up. I look for anything below 8 to consider the company undervalued. Normally, this would mean that the company is overvalued. In this case, because they have such a gigantic competitive advantages, I would peg them probably about fairly valued, especially when compared to their 5-year average. EBITDA EBIT is 28.3. They're far below at 15.6 their 5-year average enterprise value to EBIT. Why? Because their stock price has fallen pretty dramatically in the last year due to the Chinese tech crackdown. If you aren't familiar with what's going on over there, I cover this for some investment sites and that I write for. The Chinese tech crackdown is the Chinese government cracking down on tech companies over there, kind of in a similar way, except a more harsh way than what the U.S. government is attempting to do to companies like Facebook, Google, Apple over here. They're trying to bring them under more regulatory control. They're bringing down things over in China. It's called the walled garden, or in the tech world, it's called the walled garden, where a lot of tech companies didn't allow other companies' links on to work on their sites. For example, Alibaba's links wouldn't, in some case, or in a theoretical case, wouldn't work on Tencent sites. That's another Chinese company, tech company, that, and sometimes the links wouldn't work back and forth on each other's sites. That's kind of stuff is ending. Chinese government is taking more regulatory control, to put it nicely, of a lot of these companies, and that fear that the Chinese government is taking more control of these companies, and or that they could levy massive fines against some of these companies, frankly, many of these companies, for not abiding by what they should have done in the past, again, according to the Chinese government. And if they don't abide by these rules now, massive fines, potential breaking up of companies, stuff like that. That is why Alibaba and a lot of other Chinese tech stocks have fallen drastically this year. Yeah, in the last year, their stock's down 44.2% rounded up. Is that a big deal? In my opinion, for most of the bigger companies, it's not. I don't invest heavily in China in full transparency because of these kind of what the Chinese government can do over there in terms of taking more control and punishing companies than is really possible in pretty much anywhere on Earth. But in this case, I don't think it's a huge deal for gigantic Chinese tech companies. Again, Alibaba, Tencent. What's the other one? The other one, the search engine one. It's escaping me. It's a Chinese version of Google. and others that they're cracking down on. I don't think it's a huge deal for these gigantic companies because, yes, the Chinese government can do more things than most governments on earth can to their companies, in terms of taking them over, punishing them, fining them, breaking them up, all that. I don't think it's a huge deal for most of these gigantic companies because logically it wouldn't make much sense for the Chinese government to break these companies up and essentially completely destroy them. Why? Because this is an almost $500 billion company. If they did that, they'd lose out on a lot of tech revenue, or they'd lose out on a lot of tax revenue, not tech revenue, tax revenue. The Chinese government would. They would lose prestige on the global stage because they wouldn't have these gigantic worldwide tech companies and kind of so on. Logically, it doesn't make sense. Again, I don't have any further insights to the Chinese regulatory regime other than it just logically wouldn't make sense to completely destroy these companies. Especially because these companies have massive competitive advantages. I don't think the Chinese government would do anything to breach that. I just don't. Again, logically it wouldn't make sense. Now, if they're doing something they shouldn't be doing, and then maybe the Chinese government would want to punish them, I don't know. Again, I don't know. I don't deal with Chinese intergovernmental political stuff, and this is one reason I don't invest in China much, is because I don't have great insights into what the Chinese government would do in certain situations. However, from an investment perspective, from a purely investment perspective, considering the Chinese governmental stuff, I think we should continue researching Alibaba, at least go to the second stage, because they have massive competitive advantages. They're producing enormous cash flow. They have great profit margins. They have a great balance sheet strength. They are cheap compared to their historical average, even though they aren't cheap on a complete, at least on first look, they aren't cheap on what I look for, again, under 8 on EV to EBIT. They are massively cheap compared to their 5-year average EV to EBIT because of the things we just talked about. So I think we are going to do at least a part 2 on Alibaba to see what my worksheet shows us in terms of progressing further. Again, mainly this is due to because they have enormous competitive advantages, enormous competitive advantages that I don't think are going to go away no matter what the Chinese government does, because that would not be in their best interest, in my opinion. So we'll do a part 2 on this, and so look out for that. This was, again, for Micky. Thanks for recommending this. Great case study. I got to talk about some stuff we don't normally talk about here. Great case study, Micky. Hope you like this. Would love to hear your thoughts. If I miss anything, if I didn't explain something well enough, if I should explain something better, if anybody has great insights into intergovernmental Chinese tech workings, and what the plans are, that would be incredibly helpful and insightful for me. If you're just going to say blah 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 blah, shouldn't invest in Chinese companies, whatever, I'm not really going to respond to those kind of comments, because again, we're looking at this from a completely investment perspective only. If you're looking for more help, if you're watching on YouTube, thanks so much. Really appreciate it. Make sure to like, love, share, subscribe, all that good stuff. We'd also, if you do subscribe, make sure to hit the notification bell so you get notified every time we're releasing a video, and releasing new videos all the time. If you're listening on the podcast, again, thanks so much. Really appreciate it. Make sure to do all that same stuff. And if you do, or on the podcast, we'd also really appreciate a review, because the more reviews, views, listens we get to our content, the more people we can help. If you want me to look at a stock like this for you, I will do so. Again, anywhere in the world. This is a Chinese company. We've looked at, so far I think we looked at a Norwegian company, U.S. Companies, and companies from all over the world. If you want me to look at a stock for you anywhere in the world, I will do so if it meets 3 criteria. Can't be a bank, because I don't evaluate banks. Can't be an insurance company, because you actually have to dig into the 10Ks to evaluate them. And it can't be, or it has to be producing revenue. Why does it have to be producing revenue? Because I did some videos a couple months ago for viewers who were requesting companies who had no revenue, and frankly they were quite boring because I didn't have anything to talk about. Again, at this stage, I don't care about what the upside potential is. I don't care what the company CEO says they're going to do to take over the world. I don't care about any of that until fall later. So it has to be producing revenue, has to have numbers for me to actually analyze. If it meets those 3 criteria, let me know in the comments below, and I will look at a stock anywhere in the world for you. If you're looking for more specific help from me, or more specific help on how to become a better investor faster, make sure to check out our free resources below, including our 5 free gifts, which you can get the full preliminary analysis worksheet that we're going to do next time on Alibaba. You can get that to analyze companies better, faster, more efficiently. You get that part of the 5 free gifts, and you can get that for free in the description below. Same thing, you can get a free PDF copy of my book, How to Value Invest, and a free copy of our guide, 7 Tips to Picking Great Stocks and 3 Times You Must Sell. You can get all 3 of those for free at the links below in the description. And if you're looking for more specific help from me on how to become a better investor faster, make sure to check out our Value Investing Masterclass as well. You can go to mastermind.valueinvestingjourney.com, mastermind.valueinvestingjourney.com to learn more about that. Brief overview here, 85 plus videos, training videos where you will learn exactly my process for evaluating great stocks over the last 9 years. I hold nothing back, and you'll get worksheets, templates, valuation. You'll learn 23 different valuation techniques. You'll see the exact links that I use to find great stocks, and much more. You get live group trainings, access to live group trainings with the other students, one-on-one trainings with me, and a bunch of other resources, and up to $9,000 in free gifts as of this writing, or as of this recording. To find out more about that and to join our masterclass, check out, again, mastermind.valueinvestingjourney.com, mastermind.valueinvestingjourney.com. But until next time, have a great day. Talk soon. Bye.